In today's interest rate environment, I'm going to focus on the 10-year note. 10-year note bouncing a bit today, reversing the trend that it's experienced. We did see the 10-year note holding up about unchanged initially this morning. We saw the equity markets higher, but then selling pressure in the equity markets, and we saw a reversal in the bonds. We saw yields decrease. We saw bonds rally. The range for the day, 272 on the low end, 2768 on the high end, and we currently are at the 272, and that is the lowest end of the range for the day. Looking at some of the activities here, the technicals, I want to focus on technical activity. Now, we have seen really the bond market in an upward trend the last week or so, and it's been breaking the downtrend that's really been in place going back to the middle of January. So now over the course of the last week or so, we've seen the bond market break back above that downtrend in yields. Now 263 was the low end and the foundation for this recent bounce. Now that we broke above the 276 level, again, I think there's a possibility here, even though we're backing off slightly today, for it to go to that 28 level. And we saw those levels in the middle of January. And if we were to break that 28 level, then it looks like the next resistance in the bond yields for the 10-year is 292. So we've got a couple of stages here where if we continue to see this rally in rates continue even after today's back off, that you would expect 28 to be the next target. Also, some of the factors that are going to influence the bond market this week, particularly look at the 10-year yield, is the data points. Now, we did have some significant data points on Friday, which drove yields higher, pushed them up to recent highs, and those were the GDP numbers, which are stronger than expected, and the Chicago Purchasing Manager number, which was much stronger than expected. And I think that put pressure on the bonds and drove yields higher. Now this week we have housing data this week, housing starts. We also have the Fed beige book in the middle of the week, and culminating in the unemployment report on Friday. And again, that historically is a big mover for the bond market. I would expect that that's going to be the case once again this cycle.